be as keen to rebuy as you are to sell. Now, what happens is that we naturally run away. We want to be defensive. We are sensitive to downside loss. We are more sensitive to that than we are to grabbing upside.
Die Geldmeisterin. Der Finanzpodcast. Mit Julia Kistner.
Der Brexit hat im Juni 2016 zumindest mein Leben verändert. Ich habe gekündigt, weil mein damaliger Arbeitgeber nicht die Bedeutung des Ereignisses erkannt hat und redaktionell nicht sofort darauf reagieren wollte. Oder habe ich vielleicht die Folgen des EU-Austritts von Großbritannien überschätzt? Das wollte ich mich beim Briten Stephen Jones, Chief Investment Officer bei Aegon Asset Management, erkundigen, was die Insulaner und ihr Finanzplatz heute bewegt, wo am 5. September die Nachfolgerin von Boris Johnson bekannt gegeben wird. Als neue Präsidentin in Frage kommen entweder die 47-jährige Liz Tuss, die vor allem eines will, Steuern senken, oder Ex-Finanzminister Rishi Sunak, der das Budget und die Schulden mehr im Auge hat. Ich bin gespannt, was Stephen bewegt, jetzt mehr Cash als bisher im Trockenen zu halten. Er untergewichtet Aktien generell und ersetzt sie durch Anleihen. Nur britische Aktien gewichtet er neutral, wobei der britische Aktienmarkt auch nicht die britische Wirtschaft abbildet. Die Unternehmen im britischen Leitindex FTSE 100, wie zum Beispiel der Pharmariese GlaxoSmithKline, machen ihr Geschäft im Ausland. Im FTSE haben auch die internationalen Industriemetallunternehmen ein Schwergewicht, ebenso wie der Finanzsektor, der von steigenden Zinsen profitieren sollte. Hinzu kommt, dass das Pfund heuer stark gegen den Dollar und auch gegen den Euro gefallen ist. Das alles in Summe ergibt, dass der britische FTSE 100 in Pfund dargestellt nur 1% seit Jahresbeginn gefallen ist, während andere große Indizes zweistellig einbrachen. In Dollar dargestellt wäre auch der FTSE 100 stärker eingeknickt.
Julia, hello.
Hello, Stephen. Maybe at the beginning, could you introduce yourself?
Certainly. My name is Stephen Jones, and I am the Chief Investment Officer for fixed income, equity, and multi-asset teams at Aegon Asset Management.
So you could give us a brief overview how the British economy and the British capital market has developed so far since the decision in June 2016 to leave the EU.
Yeah, we lived in a period that was one of denial almost of the difficulties of leaving the European Union for the first 3 years. We enjoyed all the freedoms and access of continued membership of the single market whilst the negotiations were going on. And whilst there was a lot of distraction and political noise, the engines in the economy functioned perfectly well. And like most of Europe, we grew gently during that period, and we continued to make good, sensible progress as a country. Interest rates were low. Growth in employment was modest but positive, and GDP was pushing ahead. Inflation was very controlled. And then we had the double whammy of both pandemic and also the reality of becoming a third country and removing ourselves from seamless, borderless trade with all our friends in Europe. We were hit quite hard by the pandemic, harder in economic statistic terms than other nations. We locked down a little later. We were perhaps a little iller than other countries. We suffered more deaths related to COVID than some of our peers. And that is very unfortunate. We did support our economy very aggressively, spending £400 billion in medical, track and trace, business support, individual support, furlough, paying very generous amounts of money for people who couldn't work in sectors. And we did bounce back pretty aggressively as well. So when people did get out, then we had a very strong sort of rebound back end of 2021. And that masked some of the friction issues that were being put into trade on the back of real Brexit. And I think as the picture into 2022 emerges, you've had some of the sugar rush of COVID pandemic recovery and, very strong support being put into the economy fiscally. Had some of that fading at the same time as people have, got into a more difficult trade environment and a services delivery environment. So some pretty disappointing forecasts for the UK economy now over the recent quarters as, reality hits home. A new normal is established, and that would appear to be one that sees our growth profile lowered and inflation running at very high levels. I mean, the UK is always quite an inflationary economy. We are returning to that profile, and that is causing interest rates to have to rise as well, and I suspect continue to rise. And that in turn, risks slowing growth too much and stagflationary type activity.
Does it make sense then that year to date, if I just look at the FTSE, has done quite well with just minus 0.5 or 0.6% now, comparing to DAX or S&P 500, which lost more? Is it just the weakness of the British pound? So if I calculate it in US dollar, it would look different? Or is it because this doesn't represent the British economy and it just presents the metal business? Or how can I understand that?
All those things and a few more. It is the case that, stock are not economies and are pretty unrepresentative, really, of GDP links and people's experience of economic activity and wealth creation or more difficult times. That is particularly the case in the UK, where we have a capital market that people look at as very large cap. FTSE 100, the 100 largest companies, that's very international. There's not many sole UK businesses there at all, and which is very biased towards oil, mining, tobacco, conglomerate type names. The market over the last 6 months has been dominated by returns in oil and energy. It's really the only sector that has gone up, and it's gone up dramatically, over 25% as a sector in terms of absolute value. Mining obviously is pretty volatile, but was really, really beaten up during the pandemic and is naturally recovering as, demand patterns normalize, people think about investment infrastructure changes, especially around green infrastructure investment and the need for electrification, copper, other metals being very much in long-term demand profile. And some of the defensive names, the consumer staples, being natural places to go, perhaps during more difficult economic times. So those have been really helpful, the characteristics of the market. The other thing, as you say, is that a lot of the UK FTSE 100 names are dollar earners. Obviously, naturally comes through from energy and metals, but there's a good degree of dollar earning there. and the dollar has been the currency in the global foreign exchange markets to own. So sterling has depreciated from 130 to 120. That 8 to 10% depreciation relative to some of those earnings has boosted the company prospects. And we don't have much tech or, say, quality brand names represented in our market, which obviously has been something that has dragged US indices lower, and, say, some of the continental boxes, France in particular, or others with strong discretionary spend. The other thing I would say is that there is an assessment at the moment that the UK is in a better energy position than, say, Europe. And I think, European indices have been adversely impacted, and people's sentiment towards them in asset allocation terms is impacted by, the very uncertain picture about availability of energy, particularly gas, let alone the price. And I don't need to tell this audience about the issues there.
It has reasons why the FTSE went up then. And how do you see it right now? The energy crisis in Europe will continue at least until next spring, I guess longer. So does it make sense to overweight Great Britain? I mean, you always have a home bias, so I guess you have very much Britain in your portfolio, but are you overweighted then?
We're not. If you look at our asset allocation, we are neutral in our allocations to our home patch. And that is in the context of being slightly underweight equity overall. So we do acknowledge it as a stronger point in an equity market that, I think continues to face some challenges going forward. UK specifically, I mean, I think the structure of the market that we've talked about is defensive and supportive, but there are some clouds on the horizon as well. One of them would be the debate around taxation levels for companies in the UK. That is very much an argument in the leadership transition we are going through from Boris Johnson to a new Prime Minister. Setting of corporation tax is something that is being debated quite hard.
And does it make a difference if it's Liz Truss or Sunak? Yeah.
Yes, it does. Liz Truss, at least in what she says, would be far more sort of in a tax-cutting, capital market, freedoms, deregulating type approach. Whereas Rishi Sunak, I think, is more of a fiscal conservative in government. Had already announced tax rises and changes in corporation tax, and is probably more of a traditional, less adventurous in economic policy type person. But taxation is only one influence. I think the other influence is just on our UK and rest of the world activity is that inflation, key to anybody's thinking. Now, we are watching very closely whether companies can maintain margins in this inflationary environment. Because if you have an equity that's able to maintain margins, then you have a very effective inflation hedge. The top line will grow in line with the bottom line containment of costs. You protect margin and you continue to be able to increase dividend and value. If you don't see that, then company is a bit like a nominal bond and not particularly attractive in inflationary times. So we have to be pretty clear on earnings prospects going forward. I think we are seeing recently that companies are still pretty clear on earnings, pretty upbeat. Maybe not around retail and consumer discretionary, but in other areas, in industrials, certainly in the oil and gas sector, certainly in mining and consumer essentials areas, and indeed in financial services, in the banking sector, then earnings are really pretty good. So, that would be a support for equity going forward. But we have to watch that earnings delivery quite closely and that margin evolution.
So what are your opinion and what can protect an investor against inflation? You said the stock market has quite a challenge. What are you doing then? What do you put in your portfolio?
I think you have to take a long-term view. We have come from a period of very strong asset price growth and equity market recovery and all assets when inflation was very low. And, at the moment, we are eating into those gains with some price readjustment and a higher spike in inflation. So if you're a long-term investor, then, you look back over a 10, 15-year investing period. It doesn't feel great at the moment, but bear in mind where you started putting those euros or those pounds to work 10 or 15 years ago, the growth you've had relative to an inflation curve, the gap's getting smaller, but it is still positive. You've been right to invest in assets in markets and especially equity. And as long as inflation is peaking and going to be controlled by central bank policy and not becoming embedded, then, I think you continue to invest over the long term in a portfolio of risky assets, and you are going to see a real return. So don't be put off would be my core message. This is a long term. In the short term, I still think that commodity linked equity and or indeed commodity exposure is important as an element of hedging against inflation. A lot of our inflation is coming from commodities and energy. If you can and are willing to sponsor that in an ESG framework, and that is quite difficult, that I think is an area to look at. Similarly, the returns that are now going to be asked from new investment, some of the infrastructure and renewable energy infrastructure, which we are going to put in place. The price return needed has been reset along with government bond yields and spreads and, a overall move away from negative interest rates and deeply negative real returns. So areas of investment around infrastructure, renewables, and the transition, I think, active longer term. And finally, maybe a sector that's not been in favor for a very long time, but a higher interest rate environment and a need for delivering careful lending and support to an economy, then the financial sector, some of the banks, are perhaps worth looking at. So those would be near-term sort of sector-type views, all in the context of, not just thinking about one quarter where inflation is reported at 9% and, markets have gone down 9%, but putting it over a long-run problem where inflation has been very low. You've had very strong asset returns. You're eating into some of that past gain. Chances are that will reassert itself with lower inflation, continued growth and support, and you'll be back on track again over the long term and averaging.
So you talked about the financial sector and you talked about the commodities. Then I would be well off with the FTSE then, no? Because they have...
That is true. And in, as I say, our asset allocation, in a world where we are underweight equities, we are neutral, our UK home market. Mm-hmm. I think that is a good place to invest. For a euro-based investor, obviously you have to think about currency on the back of that investment. Euro sterling has been very stable for a long period. It readjusted in 2016 on the back of the Brexit referendum. We have traded in a very tight range. Mm-hmm. Since then, we do have this political leadership transition. Mm-hmm. That is talking sort of radical action. If Liz Tuss wins, as I say, a more sort of tax cutting, capital market, maybe review the mandate of the Bank of England around inflation and growth rather than just inflation targeting. Well, there could be some upsets there about people's perception of the UK, and that might lead to a bit of currency change. Mm-hmm. From a very stable environment to one where we get more volatile. So that is worth thinking about as well. And that is it's a neutral in the context of an underweight rather than a table thumping, you ought to just buy the UK.
Okay. But if you look at the political transmission, as I heard, the opinion polls, trust is far ahead.
We have this amazingly odd process where this is a party election. Okay. So only, under 200,000 members of this party who are in no way representative of the UK population.
That's right.
Picking between two people who 350 people have chosen as members of parliament. So it's a very odd process. Mm-hmm. But I do think their policy differences are very real. Mm-hmm. And Liz Truss is the favourite, both in the opinion polls and with those that make markets or take bets on these things. Mm-hmm. They're often quite right. So 5th of September, Prime Minister Truss, and we'll see where that goes. Yeah. All markets are more volatile than they have been for a little while. Maybe the UK will be part of that as well.
Ich persönlich, und das ist keine Kaufempfehlung, nur meine individuelle Einschätzung, die natürlich falsch sein kann, habe jetzt in den FTSE investiert, einfach um auch Rohstoffe in meinem Portfolio stärker zu gewichten und mir Einzelinvestments oder spezielle Rohstofffonds zu volatil sind. Ansonsten besitze ich eine britische Aktie im Langfristportfolio, wie ihr vielleicht schon wisst, und bin mit dem Kursverlauf und auch der hohen Dividendenrendite von derzeit 5,18% sehr glücklich, was nicht heißt, dass die GlaxoSmithKline auch die richtige Aktie für dein Depot ist. Denn ein Totalverlust, das möchte ich hier nochmals betonen, ist bei keiner Aktie ausgeschlossen. Das ist nun mal das Unternehmerinnenrisiko. To get to the Bank of England, they raised the interest rates quite sharper than the ECB. Is it because, as you said, Great Britain is an inflationary economy, or why is it possible to raise the interest rates?
We have a difficult situation at the Bank of England. The Bank of England's current mandate is the inflation at 2%. With a margin of error of plus or minus 1%. Mm-hmm. Otherwise, they have to write letters and become, more in the public spotlight, under scrutiny. Mm-hmm. They've failed to achieve that mandate now for a very long time. And that's in common with most central banks, to be honest. Mm-hmm. So I think all the central banks are engaged in trying to refine and reassert their credibility to their mandates. You can see it with some force in the Federal Reserve under Chairman Powell. You watch his press conferences and read his language, and those of his board around him, there is clearly a determination to aggressively raise US rates to stop inflation and see it come down to target and not get it in bed. I think, there's a little late conversion to that, even in the ECB. Abandoning forward guidance, we will react to it, things as they come along. A bigger rate rise than expected in the last meeting. And as ever, the UK is somewhere in the middle. And we are 1.75% in terms of cash rates. I think the disappointing thing about the Bank of England was the accompanying outlook for the economy, where they think inflation will hit 13%, 13% momentarily, relative to a target of 2% for their thing. And they in order to have any sense that they will bring that down and be credible, they have to raise rates, and I believe they will continue to raise rates. So there is another 50 basis points coming in September, with further rate rises towards 2.5%, 2.75% by the end of this year in the UK. That in itself drives some of the negative outlook for the economy, but they have to impact the economy negatively to get inflation down. And this is a series of actions around their mandate and around credibility, because they are not in a good or strong position, having missed targets in the past, having not raised rates early or with sufficient speed when times were better. And of course, this is all made incredibly difficult by the appalling events in Ukraine and around Russia, which we must condemn unequivocally, and the energy price shocks that we are all subject to. But in the UK, inflation is more than just energy. It's beginning to creep into, goods and other services. And interest rates need to be raised to try to pull that back, even if it seems counterintuitive when energy prices are going up and domestic electricity and energy bills are rising so fast.
And so, as you said, inflation is not inflation. So Britain has the same problem like the US, that there's a lot of inflation from the lack of labor.
Yes, yeah, and bottlenecks in supply. We are we are dependent on. Even if our trade with the European Union has fallen, we are still an importing and exporting nation. Bottlenecks in supply has impacted good prices. Higher input prices there generally have risen. Our services industry is quite large. There is evidence of things going up there too. And we need to slow those dynamics and bring inflation down. And interest rates, I think, will continue to rise in the UK.
Your concept against inflation as an investor would be you have to look for companies which have a huge moat, like Buffett always says. And the other thing is commodity. And there you said, this was interesting. You said you tried to get the commodity investment in a renewable framework. Could you explain this? Because there could be also the danger if you invest in, for example, in oil companies, that you have one-time stranded assets. So how do I invest then?
Yeah, and certainly also within the energy sector, you have the threat of windfall tax now on supernormal profits. And you've seen that a little in the UK already around North Sea oil and gas profits, with some offsets to allow, things not to be too tough. But you've seen that talked about in Ireland as well and in other areas. So you have to be careful in sort of that dirty energy side, where there is a lot of investment need and some good margin returns now is in renewables. Mm-hmm. The price of constructing and connecting renewable energy has come down because scale, better processes, and the price of the production from that renewable energy activity, whether it be wind or solar or tidal, has been able to go up a bit.
Yeah.
So, you're creating those businesses with margin.
Yeah.
And often in some of the opportunities offered to capital markets investors, you're being offered long-term contracts for power production relative to your investment base and locking in a margin that is double-digit, quite attractive. And we have a number of opportunities in public and in private markets to that and to benefit as, capital providers for the initial investment and long-term beneficiaries, dividend recipients from that margin from their production over long periods of time. That's an area where I think renewable transition type funds around wind, solar, and other bits of energy infrastructure is good to look.
Mm-hmm. And don't they have the problem of rising costs because they need a lot of materials?
Yes, there are threats everywhere, but again, it is a relative game. Once this stuff is built, and it's fairly easy to build. I mean, if you look at the rollout of the technology and certainty now around offshore wind, scale you can put in there. The Danes pioneered it. In the UK, we have very considerable asset base there with many thousands of turbines in place now. We kind of know how to do it. There's some of the risks of doing this in scaling up now. Proven technology and proven techniques are much reduced. So that argues against your concern about, explosive inflation in the build. Absolutely the demand for electricity and the need for renewable production of it is proven by the spike in gas, the reliance on Russia for a good proportion of European energy needs, and the like going forward. So, it's an investment. It does come with risk, but I think that that's an area to look at.
At the end, I just want to get some lessons from your asset portfolio at the moment. How are you weighted, more or less?
Well, I have talked about being underweight equity, but neutral within that in the UK. So, we continue to think of the very real tail risk that faces Europe around energy availability. Let alone price, let's say energy availability into the winter, as being something that is such hopefully a tail risk event, a small probability event, but with very large impact. That continues to weigh on in investment and business activity, consumer confidence, and European equity prospects. So we would be underweight Europe in underweight equity portfolio, neutral the UK. And until very recently, we have been a little cautious on the US as well. But I think that our view is changing there, that the US economy is more remote from some of the energy headwinds. It's a very closed economy. Actually, whilst the Federal Reserve is keen to control inflation, that actually earnings are holding up pretty well. The recent earnings season in the US is pretty good. And, so the US first, UK alongside it, Europe underweight, and Asia Pac a little underweight. They're very much energy takers as well. And China is that. China's economy is slipping quite fast on the back of the property issues and general sort of zero COVID disruption policy. We also like fixed income. So for years we have seen government bond yields rise, but importantly, spreads rise on credit product. And we are taking our equity underweight and placing it very much in high-yield fixed income markets. So, the people shy away from high-yield bonds or junk bonds. They have a very bad name for actually a universe of pretty large companies, yes, with leverage, but where funding has been termed out now in low interest rate period we've had over the last couple of years, where business models have, are well managed, where you get a spread of exposure into that US economy, which we think is probably going to be a bit better than a European or an Asia economy, and where you've got now an overall market yield return of 8%.
But you have to do bond picking. It's even more difficult than the stock market right now.
Yes, and that's why a fund where that is done for you, or indeed just exposure through an ETF into the high yield bond market, the sub-investment grade universe of companies globally, that is offering 8% in terms of nominal return, and has got a lot cheaper quite quickly, would be an area where we are taking our equity exposure, where we're underweight, and putting it into that market.
Okay, interesting.
Because, it's to some degree equity-like exposure, but it's a lot better priced, and it'll be lower volatility than equity. It's high volatility fixed income, but it's low volatility equity. You've got a price point that is really historically quite interesting. And even if we are wrong in getting in now and the price of high yield bonds continues to go down, then you have that natural cushion yield, 8% coming in and giving you a pretty good break even on a longer term view. And in the real safe part of the portfolio, then we have been quite happy to move a little longer duration in government bonds. Government bonds are, again, an investment that you can think about. 2 to 3% is not 4 to 5, but it's off zero or negative. So government bonds, as a very safe, disaster happens, recessionary type activity occurs, sort of anchor to the risky part of the portfolio. And you're back able to buy bonds or investment grade bonds now with attractive return.
So you don't think that on the long side that we see again a downturn at the interest rates because they try everything to fight against recession? I
suspect, and my view and a debate, is that the impact of negative interest rates and that as a policy tool from central banks is probably not viewed very favorably. I think it was quite interesting that, the ECB would like to get out of, in my mind, negative interest rate territory. Therefore, the zero bound for policy and bonds is probably pretty established. Okay. So, if we do go into deep recession, then those that have moved above the zero bound can bring interest rates down, but I don't personally believe that those that have just got to the zero bound are going to move again into dramatically negative territory. I think the evidence that negative interest rates really helps the real economy is pretty thin.
Yeah, that's true.
All that happened was that those institutions that owned them got wealthy. The real cost of money in the real economy didn't really come down. Spreads on consumer lending, on discretionary business loans, on small company capital provision were high. And my suspicion is that the zero bound in policy makers' mind is pretty firmly established now.
To get now really to an end, what are the main mistakes private investors do in the current turbulent or in the bear market?
Forget that it is a long-term investment horizon. You should not be doing this without a 10+ year rolling horizon for what's going on. The other thing I would say is be as keen to rebuy as you are to sell. Now, what happens is that we naturally run away. We want to be defensive. We are sensitive to downside loss. We are more sensitive to that than we are to grabbing upside. And we have to be brave sometimes. And when things look to have repriced or demand attention because they have assumed very bad scenarios in their return profile, you have to be as strong to rebuy at that difficult lower price as to sell and run away. So that is the advice I would try and give balance in your safety and your appetite for return.
Okay.
Rather than just think safety first. And do it over a long-term horizon, always having in the background, if you are fortunate enough, a cushion of cash that you can carry on living life. Now, those are very, very developed market sort of problems. Not really there for many of our citizens globally, but if you have them, try and apply those lessons.
Okay, so I hope you have a lot of opportunities now and you're brave enough. And greetings to Great Britain.
Thank you very much.
Über aktuelle Börsenaufreger und Ereignisse berichtet Werktag für Werktag übrigens die kleine Podcast-Schwester der Geldmeisterin, die Börsenminute. Überall, wo es Podcasts gibt, auf YouTube, Facebook, LinkedIn, Xing und auch auf www.geldmeisterin.com. Eine erfolgreiche Anlagewoche wünscht euch die Geldmeisterin und Julia Kistner. Und am Schluss noch der Disclaimer. An dieser Stelle wie immer der wichtige Hinweis, dass die Inhalte dieses Podcasts, der Videos und der Webseite geldmeisterin.com ausschließlich der allgemeinen Information dienen und die ganz persönliche Meinung der Geldmeisterin und von Julia sind. Es handelt sich keinesfalls um Investmentempfehlungen, Rechts- oder Anlageberatungen. Das Gesagte, Geschriebene und Dargestellte kann und soll auch nicht das persönliche Gespräch mit deiner Finanzberaterin ersetzen. Auch sind weder die Geldmeisterin noch Julia Kistner informiert darüber, wie es mit deiner Vermögenssituation ausschaut, deinen Bedürfnissen, familiären Umständen, deinem Finanzwissen, die Risikoneigung oder deinen Anlagehorizont. Anlegen erfolgt daher auf eigene Gefahr. Die Geldmeisterin und Julia Kistner haften nicht für Anlageentscheidungen, die aufgrund ihrer Medienbeiträge getroffen werden. Kurzum, für die Geldmeisterin und Julia Kistner war es immer ein Vergnügen, dich bei deinem Vermögensaufbau zu inspirieren. Auf deinen eigenen, persönlich richtigen Geldesel musst du schon selbst setzen. Viel Erfolg!